Hi and welcome to the week ahead with LCG. Now joining me this week is LCG analyst İpek Özkardeşkaya. İpek, thank you very much for joining me. Now first let's talk about this week. It's been quite eventful. I mean the ECB, it seems they did everything and the market still didn't buy into it. Why is that? What happened?
Well, we knew that ECB was going to do something, and when Mario Draghi just came out with his blue tie, which is the whatever it takes tie, we knew that something was going to happen. But once again, it has been a very hectic market environment. So first, when the decision came, so the euro tanked two figures because the ECB decided to cut all three rates to put 20 billion euros more in the quantitative easing on monthly basis and announce a TLTRO. So this was Mario Draghi did whatever he could do. I mean, he couldn't do more. And when he started talking, then something exceptional happened. The euro-dollar rallied four figures, and this is where nobody really understood what was going on. So he couldn't convince people, or nobody believed that they could carry on, or the fact that we hit the bottom on the rate strategy has been a trigger for this rally in euro, or nobody really knows what happened. But we know for sure that something that Mario Draghi didn't meant to trigger happened, and now the euro dollar is trading hit like 112.18. Now we are back below 111, and it's just like very hectic, very difficult to see what's going on. The only thing I'm going to remind you is that the last time, so in December, Draghi had put a similar action on the market. The euro dollar had rallied by 5 figures. So now, is it going to be the case? Are we set to go to 115? So that's the question.
We shall see. So obviously ECB was big this week. Next week we've also got plenty of rate decisions. We've got the Bank of England. Also don't forget the Federal Reserve meet as well. What's important here?
Well, we've got the FOMC, as you said. We've got the Bank of England. We got the Swiss National Bank. We've got Norges Bank. So basically, let's start with Fed. The Fed is expected to maintain its policy as it is, and the probability for a rate hike is 2%, so it's almost inexistent. So the first rate hike might happen in June according to market pricing, and the probability for this is 51% only. So the FOMC, we don't expect anything special. So there will certainly be some mention about the Chinese economy and other central banks easing. So Reserve Bank of New Zealand eased by a surprise 25 basis points this week. We have got the Bank of England, which is not going to act. It's going to be status quo. The Swiss National Bank is expected to leave its rates as they are, even if we have time to time some expectations of a more negative rate on table, and then it's off and it's back on. So basically, the SNB has some political issues, some political responsibility. So they're basically not very flexible on that one, so we don't expect them to do anything. Norges Bank, however, is expected to cut its rate by 25 basis points to 0.50%. So it's going to be a central bank game. Again, it's going to be who cut more, and so the currencies will be rallying or falling or faltering, will be moving according to central banks. And in this whole scenario, we have got very little data coming on the economic calendar, and they will be really kept on the second line.
Well, that was actually what I was going to ask you next. I mean, is there any real interesting pieces of data next week besides all the central bank rate decisions?
There is. We've got the Eurozone inflation figures, which doesn't matter anymore, I guess, because now that we had the Mario Draghi pulling out the bazooka and market didn't react, the only thing we will be looking at is the retracement of whatever happened, the unexpected reaction of the market. So the inflation data will be totally secondary. In the UK, we have the unemployment data coming up. So the fact that the unemployment rate has gone low enough is a good thing, but we will be looking at the average weekly earnings. They are expected to have expanded to 2%, which would be good actually, because the average, the weekly earnings is the main indicator of inflation expectations. But again, the Bank of England has not anything to worry about inflation, because we are at 0%, and the inflation target is far away at 2%. I just also want to mention that according to the market, the Eurozone inflation target of 2% is not seen to be reached anytime before 15 years, according to the market. So this is where we are. And finally, Australian dollar. The Aussie unemployment rate is due also. We had a surprise hike to 6% last month. So if we have a second surprise like this, that might be a little bit of negative on the Australian dollar, because the Aussie dollar has went about 75 cents level this week. So it seems like it's rallying right now to 76.55, could be the next level to watch. But from now on, the macro funds, macro managers will be stepping in the market, saying that, okay, this rally has exhausted, so maybe we should start building fresh positions, mid to long-term positions on the downside. So I think that the Australian dollar is going to be an important watch regarding from a trading perspective. About 75 cents, if you're a mid to long-term trader, then you can consider rebuilding your position. Or if you're a short-term trading, you should be careful about the potential that is left for the Aussie to rally higher. And this is pretty much it, really.
Okay, you gave obviously key levels to watch in Aussie dollar. Any other interesting FX pairs you're potentially looking out for next week in terms of levels?
Well, I know that everybody is asking for euros. It's very difficult, actually, because we had something completely different than expected. So from a pure technical perspective, euro dollar has gone to 112.18, and post-Draghi rally, for it to continue, we should find a base on pullbacks, should find a base at 110.68, 110.70 levels. If we go below this level, that means that we'll be back in bullish consolidation zone. Then we'll be seeing again the 200-day moving average coming back on table. This is about 110.45, and then the 110 mark, and see if Mario Draghi's measures, once the market digested the information, could actually start a sustainable slide on the downside. If, however, the 110.70 level is kept as a good support, then we might see an expansion of gains back to 113.76 level, which has been the February 11th peak, and why not 115?
Okay, thank you very much, Ipek. That was Ipek joining us for the week ahead. Now that's all for this week, but join us next week. Goodbye for now.